Welcome to RBC's Markets in Motion podcast, recorded May 19th, 2025. I'm Lori Calvasina, Head of U.S. Equity Strategy at RBC Capital Markets. Please listen to the end of this podcast for important disclaimers. The big things you need to know. First, the S&P EPS backdrop has stabilized, but we still anticipate further downward revisions for 2025. After a preliminary model refresh, we're maintaining our 2025 EPS forecast of $2.58, below the bottom-up consensus of $2.65. Second, we've updated our S&P 500 valuation model to reflect updated RBC House views on key macro variables like rates and inflation. It suggests that last week's gap up in the stock market was largely deserved, but that upside from here may be limited without another major step-up improvement in broader macro expectations. And third, we run through our thoughts on the Moody's U.S. debt downgrade from a U.S. equity market perspective. If you'd like to hear more, here's another 5 minutes. While you're waiting, a quick note that in a few weeks, voting in the 2025 Extel Institutional Investor All-America Research Survey will be opening up. If you found this podcast helpful, we would appreciate your support in the portfolio strategy category again this year. Last year, we were honored to come in number 3. Now let's jump into the details. We'll start out with takeaway number 1. The S&P 500 EPS backdrop has stabilized, but we still anticipate further downward revisions for the year. Over the past few weeks, we've been highlighting how the earnings backdrop has stabilized, which has helped U.S. equity markets find their footing. One example in the stats, the rate of upward EPS estimate revisions hit 28.5% a few weeks ago, its typical non-crisis low, and it's now rallied back up to 42%. Meanwhile, bottom-up consensus for S&P 500 EPS is also holding steady at $2.65. After a preliminary model refresh, we're maintaining our 2025 S&P EPS forecast of $2.58, which is below that bottom-up consensus of $2.65. We refreshed the model last week for the new changes published by RBC's economists and rates and FX strategy teams. Key numbers were 1.2% annual real GDP, 3 Fed cuts, 10-year yields moving up initially, then ending the year at 3.8%, and inflation in the upper twos. We also moderated our assumption for 2Q margin pressure. The exercise confirms to us that 258 is still a reasonable expectation for the year. Beyond our modeling, history also points to the need for some downward revisions from here. Typically, the bottom-up consensus is cut by about 9% from the middle of the prior year. That would take 2025 number to around 250. Importantly, cuts tend to be completed by the middle of the year in question with stability in the back half. Moving on to takeaway number 2. We've also updated our S&P 500 valuation model to reflect RBC's updated house views on key macro variables. It suggests to us that last week's gap up in the stock market was largely deserved, but that upside from here may be limited without another major step-up improvement in broader macro expectations. Our trailing PE model forecasts where the multiple for the index should be at year-end 2025, based on year-end assumptions for inflation, 10-year yields, and the Fed. When we bake it all together, the model is now calling for a trailing PE of 22.2 times at year-end 2025, which produces a fair value estimate of 57.30 for the price level on the S&P 500 when we use that multiple in tandem with our refreshed 258 EPS forecast. The implied fair value level for the S&P 500 rises to 58.84 if we use the bottom-up consensus EPS forecast of 265 instead. Looking at both numbers, this exercise leaves us feeling like the gap up in the S&P 500 at the beginning of last week made a lot of sense in the context of the latest U.S.-China trade developments, which we see as reducing but not eliminating the headwinds to GDP growth and the tailwinds for inflation that have emerged since the start of the year. However, upside from here on the S&P price through year-end seems limited without another step-up improvement in expectations for the macro backdrop, and the stock market may simply be a little ahead of itself from a fundamental perspective based on where it's trading right now. Let's wrap up with takeaway number 3, how we're thinking about the Moody's debt downgrade from a U.S. equity strategy perspective. This is a battle being fought mostly in the bond market, and on the U.S. equity side, there are really 2 issues that we're focusing on. First, we are watching reverberations in the bond market, specifically 10-year yields. Our earnings yield gap model has been in a favorable range for stocks for now, but will hit a level typically bad for stocks on a go-forward basis if 10-year yields hit 5.3%. Second, we see the Moody's downgrade as part of a more broadly problematic shift in the market narrative that's coming simply at a bad time. Post-earnings, the stock market has been in need of a new catalyst to keep moving higher. And as discussed already, we think stocks look fairly priced for the recent improvement in macro expectations. Last week, investors we spoke with were optimistic, starting to move beyond tariffs and focusing on the benefits of tax cuts and deregulation. Now we're starting to see headlines caught up in tariffs again, while the path of the tax bill has gotten complicated, and the Moody's news has brought attention back to the country's fiscal health and the Sell America trade. Taking it all together, we wouldn't be surprised to see the U.S. equity market take a breather as the news flow shifts. That's all for now. Thanks for listening, and be sure to reach out to your RBC representative with any questions.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.